Warren Buffett warns about diversifying your portfolio. This is your biggest mistake. When it comes to the topic of diversification, there are two schools of thought. Some believe diversification is a waste of time, while others think portfolios should be widely diversified. There is no correct answer to this. Some investors might be happier with a concentrated portfolio. Others may not be able to tolerate the volatility. However, whichever course of action you decide to take, it is essential to understand why you have taken this decision and the factors that have influenced your diversification plan. Today we're going to talk all about what Warren Buffett warns about diversifying your portfolio. So watch the video till the end, because today's video is going to be the bomb. Welcome to Investor's Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. The reality is that each investor is different, so there's no one right answer to the topic of how much diversification one should have in a portfolio and whether or not one is diversified enough. It really comes down to personal preference, and as Buffett says, whether or not you truly understand the businesses you're investing in. The puzzle of diversification. It is true that many successful investors and business people can trace the roots of their success back to a highly profitable company or a single investment. However, this analysis is steeped in survivorship bias. Everyone knows the name of Mark Zuckerberg and the company that made him rich, Facebook. Still, for every person who got rich investing in Facebook, there are probably 1,000 individuals who invested everything in some other flashy internet stock and lost it all. Even Buffett has never come close to risking all of his capital in one investment. His most significant investment in terms of total assets was Geico stock in the 1950s. He invested around half of his net worth at the time in the company. This trade worked out, but he still would have been left with 50% of his capital if it hadn't. Buffett's most significant investments have never really exceeded 50% of his net worth throughout his career. At the time of recording, Berkshire Hathaway's investment in Apple accounts for around 41% of his equity portfolio. But we should view this investment in the broader context of the conglomerate. With more than $700 billion worth of assets, the Apple holding makes up approximately 17% of assets overall. Buffett has never said investors should avoid diversification entirely. It seems as if he has always believed investors should have some diversification, but not too much, and not if it comes at the cost of investing in things they don't understand. Indeed, Buffett has said in the past that all one needs is 3 wonderful businesses to get rich, although he has also noted that 6 wonderful businesses could be all the diversification you need. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich with their best idea. So I would say for anyone working with normal capital who really knows the businesses they have gone into, 6 is plenty. This is something investors should keep in mind when looking for different assets to add to a portfolio. Excessive diversification can be detrimental to returns, but some diversification into companies that one understands well will not likely end in disaster. In fact, having just a bit of diversification can protect against disaster. This is all said with the warning that diversification does not make up for a lack of research. The easiest way to reduce risk in a portfolio is through research. Buffett's advice on diversification is worthless if it is not coupled with rigorous investment research. Why most investors may benefit from diversification. The idea behind building a well-diversified portfolio comes down to the concept of not wanting to put all of your eggs into one proverbial basket. We often see on a year-by-year basis that the asset classes that are the best and worst performers tend to move around a lot, says Amy Arnott, a portfolio strategist at Morningstar. Diversifying can help you avoid overexposure to an area that's suddenly out of favor. It can help reduce your portfolio's volatility to be invested in assets that are uncorrelated or that have relatively low correlation. In other words, by buying in a mix of investments that tend to perform differently at different times, you reduce the odds that any one poorly performing investment is going to drag your overall portfolio down. That strategy is important for 2 reasons. For one, it helps keep your emotions at bay. Big drawdowns in your portfolio aren't necessarily a big deal if you have decades to invest, so you can hold on and wait for a potential rebound. By reducing the amount your portfolio stands to lose during market pullbacks, you make it less likely that you're going to panic and sell when you see big red numbers on your brokerage screen. And by spreading your risk across the portfolio, you can generally expect to achieve better, more stable returns over the long run, says Lauren Hunt, a certified financial planner and senior advisor at Moneta Group. Building a portfolio where nothing moves in the exact same direction will give you a blended return, she says. Research has shown that those portfolios will get you a higher risk-adjusted return over time. In short, diversifying means you maximize your returns relative to the risk you take as an investor. How to diversify, the basics. If you're a beginner investor, there's no need to try to spread your portfolio thin across dozens of investments, says Arnott. If you're just starting out, you can feel good with a diversified U.S. stock fund and a diversified international stock fund. By choosing funds that cover huge swaths of the global stock market, you ensure that you have exposure to companies of different sizes in different businesses across different geographies. A total stock market fund will give you exposure to several thousand of the largest stocks in the US, and a total international stock fund will have you investing in foreign businesses. Depending on your tolerance for risk and how close you are to retirement, the other base to consider covering is adding bonds to your portfolio. Over the long term, bonds will typically offer a lower return than stocks, but for much less risk. If having an all-stock portfolio will keep you tossing and turning at night, or if you're close to retirement and can't financially withstand a shock to your portfolio, a greater allocation to bonds could help you preserve your wealth if stocks tank. One easy way to solve the bond question, says Arnott, is investing in a target date fund, which will hold a diversified mix of stocks and bonds that will grow more conservative, more heavily invested in bonds, as you near retirement age. With a target date fund, you're getting built-in diversification with exposure to most major asset classes and an asset mix that changes over time, says Arnott. It's a great way to get diversification in one package without having to worry about building a portfolio with 10 different funds. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye!